This, in part, is a consequence of the 2020 Fed decision to reduce bank reserve requirements from 10% to zero. Now, that means that banks are not required to keep any amount of their assets, in other words, your deposits, in cash or liquid equivalents to be able to service requested withdrawals. People at the time warned that these would be some of the consequences. So we are seeing these chickens, as it were, coming home to roost. Now, to mix my metaphors, we can't say it's a canary in the coal mine. It's not quite that far. They are examples of a looseness in monetary policy, a change in interest rates policy, but these changes in reserve requirements have created a structural weakness within the system.
There's much discussion of the U.S. Federal Reserve Bank in this context as sort of the proximate cause for raising interest rates. I'd like to turn to the failure of the Federal Reserve Bank as a regulator of banks in the United States. SVB had all sorts of red flags on its financial statements. It had grown in deposits very, very rapidly, from about 50 billion in 2018 to over 220 billion in 2022. This is a number one signal for financial services regulators. I'm a former insurance regulator. This is something that you when there's a very, very rapid growth, you keep a close eye on that particular firm. SVB it was something of an outlier in this case in terms of the amount of its assets that it had invested in long-term risk-free bonds. So it clearly had indicated a number of red flags that should have been picked up by regulators. The California regulators had the primary responsibility, but state regulatory agencies are often underfunded. Really, the Federal Reserve Bank should have noticed. This is a very large bank. They should have been paying attention.
One might call it US-style destructive capitalism, in the sense that the rise in interest rates is going to strangle the weakest in that sector. And the hope is that provides merger and acquisition opportunities for other banks to buy out those weaker banks. What we have to be careful of is that those companies, particularly in the tech-heavy sector, who have been impacted by the SVB collapse, is that they will need to refinance. And that becomes more expensive as interest rates rise. That's going to have an impact on the trajectory and the momentum of tech development in the United States. And that's probably the most important outcome of what's happening at the moment, rather than a general weakness within the banking sector.